Well, when we sent out the announcements to this seminar, a friend read and then asked me, why are you going to talk about debt again? It's such a downer. Why not talk about investor sentiment or emerging economies or something far, far more upbeat than that? Frankly, I like to talk about quite a variety of subjects, and as Susan mentioned in the intro, I try to put something up on our blog every week, and I've been pretty good about being able to do that. A couple of times when I'm, as was the case this week, in getting ready for this session, I had to fall back on one that we put up a couple of years ago with some minor edits, but I always identify that at least, so you'll know it is a repeat, but most of the people weren't reading it two to 3 years ago. And since we typically only schedule about 3 of these seminar sessions a year, I try to focus on what I consider to be the most critical factors, whatever is going on in the market or the economy at the time of the seminar. And for most of the past dozen years or so, the overriding factor that has affected world economies and markets has been excessive debt. Every day we focus on markets in the context of serious excessive indebtedness. Debt accumulation was an integral factor in promoting and sustaining the last long, strong economic cycle, which largely spanned the decades of the 1980s and the 1990s. The resulting excessive debt and excess valuations led us correctly to forecast at the end of the 90s the probability of a coming long, weak cycle, which cycle I would suggest we are still fully involved in right now. Unraveling of the debt problem led to 2 massive stock market declines and 2 major recessions since the beginning of the century. And most stock market indexes today are below where they were a decade or a little more than a decade ago. But the debt problems remain. We've seen a nice stock market bounce, certainly. But in fact, many of the debt problems are even worse today than they were at the beginning of the long, weak cycle back at the turn of the century. And how these debt problems are dealt with will be the single biggest determinant of economic and market progress in the months and years ahead. You have to look at debt, and you have to continue to look at debt. If you're not analyzing debt, you're looking at the trees, not the forest. Notwithstanding the huge increase in debt, a number of very positive things have happened over the past 2 years. And if you take a look into your booklets on the very first page, we'll look at some of those positive conditions. We've had a flood of money and credit coming into the economy, and certainly there is the potential for more, notwithstanding the Fed saying that we aren't going to have a QE3. There are certainly a great many people who suspect that we will perhaps have QE3, 4, maybe 26, who knows. The Fed's been increasing its balance sheet and essentially making money available to the economy from about $850 billion before the QEs began, to about 2.3 trillion today, with more coming through June. And we'll see whether that marks the end or whether perhaps the political pressure gets a bit intense and they may not be able to put any more new money into the economy. Corporate profits are rising. Clearly, that's been a very strong theme of the past few years. Businesses have reduced the number of employees, and they've gotten leaner and meaner, and their productivity has increased very substantially. Profits are forecasted to continue to rise at least through the end of this year. Profit margins are near historic highs, and that's a good thing, but it's a bit of a mixed blessing because profit margins tend to be cyclical and mean reverting. And so when you get near all-time highs in profit margins, essentially all you've got left is to see them start turning down. So we're at that point where we're very close to the all-time highs in profit margins. So at some point, whether it's now or soon to come, we're very likely going to see them start to decline. Corporate balance sheets have improved. Many companies have bought back their own stock. Current profitability and floating long-term debt have built cash reserves. So you've had a lot of companies that have not necessarily eliminated debt, but they have taken their short-term debt, funded it with much longer-term debt. So essentially they have built their liquidity, and that's built some barrier to potential problems in the years ahead, because they don't have the immediate problem of having to fund that debt that was formerly quite short-term. Interest rates remain historically low. You can't tell how much is from natural causes, though, or natural investor causes, let's say, because with the QEs, the Federal Reserve has specifically said that they were targeting interest rates. And with QE2, the Federal Reserve is buying about 70% of every new U.S. Treasury issue. So there's certainly a tremendous amount of buying power that the Fed is putting into the market. The question that's being bandied about very regularly by all great numbers of people is who will step in and be the buyer when the Fed steps away once QE2 finishes at the end of June. We don't know the answer to that. They're clearly putting a huge amount of the buying power into the picture right now, and that has kept interest rates far lower than they probably would have been otherwise. Stock markets are higher. The Fed points to these as the success of QE2, even though reducing interest rates really was the prime objective in setting out on the Qs. Business and investor confidence is up. Essentially, free money has pushed stock prices and profits higher, and success breeds confidence. So as business has grown, confidence has grown, and that sort of thing. And that's a big part of what the whole QE process, quantitative easing process, is designed to do. It's designed to get things going so that the confidence will build and hopefully become self-sustaining. What happened after QE1 gives us pause as to whether it is self-sustaining yet. After QE1, stock market declined and some of the economic indicators started to roll over, and that was the reason the Fed implemented QE2. They saw it wasn't yet self-sustaining. Whether it will be at the end of QE2 is an open question. We'll look at some of the factors that might determine that as we go a little further along in the talk. Business cycles are normally longer. That's one of the bullish arguments right now, is that now that we've gotten a stock market rising now for a period of 2 years, and the economy has been rising similarly for about the same amount of time, business cycles normally extend more than 2 years. So the expectation is, now that we're in an upward cycle, this should keep going, at least for a while longer. One possible caveat to that interpretation is that this is not a natural cycle. This is a cycle that clearly was begun and has been continued with Fed support, dramatic Fed support in the form of a larger amount of money being infused into the economy than any government or Federal Reserve Bank has ever attempted in world history. So it's an open question whether This is a kind of cycle without the federal stimulus that will be able to continue on its own merits. Emerging market countries are growing strongly, and clearly they have been. They have really taken the leadership in this economic growth away from the developed countries. The developed countries, in fact, have grown at a very moderate pace. It's the emerging countries, and the most famous of those that everybody talks about are the BRICS, the Brazil, Russia, India, China. And these countries have really taken the lead. It's interesting, though, to look back. Those countries have, in fact, no emerging countries have ever been able to lead a sustainable world expansion before. Now, is it possible today? Sure, it's possible. They're bigger, they're stronger than they've ever been before. So it certainly is possible. But a lot of them have gained their strength from a tremendous infusion of money. We have as well. But the BRICS and other emerging countries have thrown far, far more new money into their economies even than we have. So there are a number of very strong positives that have evolved over the past couple of years. But as I indicated earlier, we have to evaluate all of these factors in the context of excessive over-indebtedness. And I would suggest you turn over to the next page in your booklets. This is a graph that those who've come to our seminars over time have seen any number of times, and I always like to update it because it's one of the most important graphs that I think we look at. A quick explanation for those who've not seen it before. This is a debt to GDP graph. So it's the total credit market debt that includes government, corporations, and individuals through things like securitized mortgages and so on, compared to the size of the economy as measured by gross domestic product. And you can see in this little upper area, you see the equation. Total credit market debt divided by the GDP. We're at a little over 350% of GDP at this point. And you can clearly see the pattern from the the mid-1920s on through present. And with this exception, we never had a tremendous expansion until we got to about 1980, and then debt to GDP just exploded. This, by the way, just again because it's a ratio, if debt were growing at the same speed as the economy was growing, you would have a flat line across. What this tells you is debt is growing far, far faster than the economy is growing. Now, what we do see up here is a change for the better in terms of the ratio. And so we've lost some debt relative to GDP. The only negative in that is that the bulk of that decline is not from people having paid off debt, but rather people having defaulted on debt through foreclosures and other types of default. So, and the unfortunate thing by way of precedent is that the only other spike we see here, which was through in the Depression in the 1930s, this decline came not because we paid off the debt, but rather because we defaulted a great amount of it away. So we hope that's not the precedent for what happens here, but it is the only precedent we have to any other dramatic surge in the debt to GDP ratio. Page 4 shows debt in a somewhat different way. The first page showed total credit market debt. This page looks just at government debt, but it shows several different ways of measuring that debt. It's generally agreed by kind of long-term historical analysis that crisis, some kind of credit crisis, debt crisis, is potentially imminent when government debt gets close to 100% of GDP. And what you have here are 4 different ways of looking at how much is our government debt relative to GDP. The lowest line down here which doesn't look very threatening at all. It's only at about 60-some%.